Hello everyone and welcome to another episode of the VMC Inc. Financial News Network. I'm Victor Campos. Well, 2016 has not been starting off very well. S&P is down, Dow Jones is down, NASDAQ is down. So many global factors affecting markets in the US. Well, let's talk about one of the strategies that we recommend to really help safeguard against some instability. So we've talked about the VMC Inc. Financial ETFs portfolio before. These are ETFs that we recommend for you in the long term. ETFs, of course, are exchange traded funds. They are basically baskets of stocks. Many different companies are within an ETF, and therefore that provides built-in diversification. So on another episode, we talked about our bond ETF, because you should have a mixture of stocks and bonds. And our bond ETF is Vanguard's Total Bond Index Fund. We recommend Vanguard ETFs. Well, let's talk about another very valuable ETF that you should have in your portfolio, VYM, which is Vanguard High Dividend Yield Fund. Well, let's look at why VYM should be one of the ETFs in your portfolio. I'm currently using TD Ameritrade to pull up this data. I highly recommend them. Send an email in the link in this description for an Ameritrade offer. So Vanguard High Dividend Yield Index ETF, $63.28 per share. Here's what it did for the previous year. Mostly in the negative range. There was a huge sell-off in August that really affected a lot of equity. So if we simply look at this chart, you might say, why would I invest in an ETF with so much negative, so many negative results? Let's look at the details. The Morningstar style box here, these 9 quadrants show that it is a large cap fund. So it's full of stocks, it's full of companies that are large cap, large capitalization, companies that are worth a lot of money, that can be very stable. And it's in the value column. So that means that it's about companies that also pay oftentimes a dividend. So it's value and large. Risk is below average, because basically the more risk, the more return you can get. The more volatile a fund or a stock is, the more you could earn from it. But also the higher possibility that you can lose from it. You can lose your money. This has got a below average risk, so your money's a little safer. But then this bucks the trend from low risk, low rewards, because it's got low risks and high rewards, one of the highest rewards, as we'll see why in a moment. Any fund is usually going to cost you to invest in it. The gross expense ratio of this fund is 0.10 percentage points. And this is actually one of the lowest expense ratios in this space. There are many funds out there that will claim to give you great returns, but fail to tell you that it will cost 3%, 2%. That is, whatever you're investing into this fund, you're going to be paying simply to be an investor. And this fund, VYM, has a very low gross expense ratio, so you keep more of your money. So, breaking things down, trailing total returns. In the past month, it hasn't been so good. The return on investment has been negative 1%. In the past 3 months, however, it's been 7.5% positive. The past 6 months, a little bit less than 1%. Year to date, which is funny because we've only been in the current year for 4 days, but it's 0.28% in 1 year, 0.28% in 3 years. If you held on to this fund for 3 years, you would on average get nearly 14% return on your investment. Try getting that from any bank. It doesn't exist. Even the 0.28 Many banks don't offer that amount of return. My bank's is barely a 0.1% return of my investment. Holding on to these funds, this particular fund that is, can be much more profitable, as we're seeing. This fund is about to be 10 years old, and notice how it's been giving us a return of 6%. If you look at the performance of the fund as well, we'll see that if we had invested $10,000 5 years ago, that $10,000 would be worth more than $18,000. No bank is going to be able to match that. Investing $10,000 in 5 years, it's not going to be worth $18,000. If we look at this in 1 year, it's a lot more volatile, but again, investing is a long-term thing. In 1 year, it would still be about a little bit over $10,000. At one point, it would have been under $9,500, but you wouldn't get spooked because quickly it recovered. In 3 years, again, there's been ups and downs, but in the long term, lots of ups. And in 5 years, ups and downs, but it all comes out to a lot of ups. You can further look at the details, what happened year by year. For example, how did this fund do compared to the S&P 500 in 2011? It beat it by 16%. In 2012, it beat it by 32%. In 2013, it beat it by 13%. 2014, it beat it by 1.38%. And last year in 2015, even though it was a pretty volatile year, still beat the market. The S&P 1.38%. So the point of that is, instead of trying to pick the right stocks, an ETF that is a collection of stocks that works a lot better because of diversification. I'm going to jump over to the portfolio screen to show you that. You don't want to put all your eggs in one basket, and that's what an ETF does. It chooses different sectors and different companies to create a diversified portfolio, so if one section of the market decreases, it might not affect the others. So there's 23% in cyclical sector, 34 defensive, 42 sensitive. Further down here, this might make a bit more sense. These are the top 10 companies that are in this fund. We've got Microsoft, Exxon, Wells Fargo, General Electric, Johnson & Johnson, JP Morgan, AT&T, Procter & Gamble, Pfizer, and Verizon. So big companies worth a lot of money in different industries, different sectors, all balancing out this ETF. That when individually perhaps a company might have a bad quarter or a bad year, but when the risk is spread out on various companies and sectors, the result is much better in the long term. Look at ratings and risk. Over the past 3 years, the fund has a 4 out of 5 rating. Over the past 5 years, a 5 out of 5 rating. 10-year rating isn't in yet. We'll have to wait for November. But overall, it's 5 stars. Below average risk, and returns are either above average or high. Well, what does that mean? If we look on the chart, what it did for 1 day. Opening price was about $64.48. Closing price today was $63. So it lost some value on paper. What did it do for the past week? Looks something like that. Downward trend. The past month. Downward trend. The past year. Kind of volatile. There was a value. It increased. Recent Chinese volatility is spilling over to US markets, so it's down. But if we look at this in terms of 3 years, it's much higher. 3 years ago, the fund was worth $51.52, and even through this bad time, it's still worth $63, more than $10 worth what it was 3 years ago. 5 years ago, same thing. It was only worth $42. If you bought it back then and held on to it, your shares of this ETF are worth a lot more. And 10 years, the fund was first opened $50.68, and today it's $63. So again, $13 increase in value. There's the 2009 crash. It went down to $25. But what if you had bought this stock at that time? Notice how much more it would be worth. We can never predict how low or how high a stock will go. So you just want to invest in a good stock ETF and hold on to it, because this particular stock, since it's a value stock, it also pays dividends. So here in the 1 year view, if I also check show dividends, we have quarterly dividends. So back in March 2015, there was a 46-cent dividend. Then the next quarter, 56 cents. Then the next quarter, 52 cents. And then the next quarter, 59 cents, 60 cents basically. When the ETF value had crashed, it still paid a very healthy dividend, 52 cents per share. So obviously the more shares you earn, or that is the more shares you own, the more dividend you get back, in addition to the value of the ETF itself. You own 10 shares of this ETF, an extra $5. 100 shares, an extra $52. 1,000 shares, an extra 528 shares. These dividends themselves, if you've got them reinvested, are going to be growing you more shares. So it's money on top of money. It's compounding to a degree. So that's why, one of the many reasons why the Vanguard High Dividend Yield ETF is the way to go, the way to diversify, to have a fund that is very affordable to buy into, a fund that offers great returns and a below average risk. So ride out the volatility, invest in the market, and you'll see your returns if you're patient. We'll talk about our other ETFs in our hypothetical portfolio on another episode, but this has been Victor Campos for the VMC Inc. Financial News Network. See you next time.